Hello and welcome to This Week on Wall Street, your essential briefing into what matters most in markets. I am Matt Weinschenk. I'm the Director of Research here at Stansberry Research, and it has been quite a week. I'm sure you've heard by now, President Trump just went big with tariffs, and when I say big, I mean really big. The markets were primed and prepped for significant tariffs, but Trump went bigger even than those expectations. So let me try to break this down for you. There are now 10% blanket tariffs on all imports. That's just the starting point. Each country could face a higher tariff based on what Trump estimates they charge us. Now, where these numbers come from isn't exactly clear. They don't make a lot of sense to economists, but they result in things like 34% tariffs on China, 20% on the European Union, 24% on Japan, just to name a few. So the immediate reaction from markets has been a complete bloodbath. As we're recording this on Thursday, markets have dropped about 4%. Among the biggest losers are things like consumer discretionary, durables and appliances, transportation stocks, energy, apparel companies. It's really across the board. We know mainstream economists have been telling Trump that tariffs were a bad idea, and so did U.S. business leaders. But the market has been telling Trump the same thing as well. Now the market is screaming at him. These tariffs are going to cause a big hit on our economy. So Trump and the small group of advisors who do favor tariffs have their own argument. They promise huge tariff revenues, a reduction in the U.S. deficit, a resurgence in American manufacturing, which will lead to fresh jobs and wage increases. And they're sitting there and they're shrugging off the market short-term pain, saying that it will be worth it for the long-term benefit. But look, markets are smart. They look forward, they judge the future, and right now they're telling us that Trump's grand plan simply will not work. On a bigger perspective, evidence is piling up that America's financial empire is in decline and that the age of American exceptionalism may be over. So let me be clear about exactly what I'm talking about here. America's still a great country. It has the largest, most dynamic economy in the world. It's full of great people and great businesses. But over the past 2 decades, America has enjoyed a very specific financial advantage. Because of its powerhouse economy and its dependable markets, the U.S. has been a magnet for global capital inflows. Now, this has particularly been the case since the global financial crisis. In general, that crisis made investors more risk averse. And while many nations undertook austerity measures to balance their budgets, that led them to have slow recoveries for the economy. The U.S., on the other hand, increased its fiscal deficits, and its economy grew quicker than the rest. So all this disparity attracted capital, which has helped power our markets higher, keep our interest rates lower, and push the value of the dollar up. So in the chart you're seeing now, you can see that this is called the net international investment position of the U.S. This is sort of a balance sheet that compares the foreign assets that U.S. residents own with the U.S. assets that foreign residents own. So from 2006 to today, foreign investments in the U.S. have outpaced our investments in foreign assets by about $26 trillion. Okay, this is a good thing for the U.S. market, as foreign investment has driven up U.S. asset prices, okay? American businesses have earned a premium valuation. Today, the CAPE ratio, which is a measure of long-term valuations, shows that U.S. stocks are more expensive than any other region. Moreover, to invest in U.S. assets, foreigners need to sell their own currency and buy the U.S. dollar, which has led to a huge bull run in the dollar. Now, this creates a virtuous loop as well. Foreign investors who own dollar-denominated assets like to see the dollar rise. It boosts their return in their own currency. But now, all this is starting to turn around. The U.S. dollar started to roll over in early January, and it's tanking further on this tariff announcement. Now, looking forward, President Trump wants to weaken the dollar going forward. This is part of the fabled Mar-a-Lago Accord that we've heard about. So we haven't seen a full trend reversal just yet, but if a bearish outlook on the dollar is adopted by global markets, it can become a self-fulfilling prophecy. Now, Already, global stocks have started to outperform their U.S. counterparts. As you can see in the ratio of U.S. stocks to the rest of the world, when this ratio rises, it means U.S. stocks are outperforming, and when it falls, it means foreign stocks are outperforming. Now, you can see that for nearly 2 decades, U.S. stocks have been on an amazing run, but that has radically reversed since the start of the year. And there are also bigger signs that the U.S. brand, so to speak, has been tarnished. For instance, Europe has decided to massively ramp up defense spending because it doesn't trust the U.S. government any longer for protection. Likely incoming German Chancellor Friedrich Merz says this is no longer the America we used to know. So in that situation, historically, U.S. defense companies have dominated the global defense industry, but in this case, their stocks have struggled. Meanwhile, European defense stocks have gone absolutely parabolic. You can also look at tech stocks. Take a look at the Magnificent Seven compared to Chinese technology stocks. Our mega cap tech stocks are supposed to be the paragons of American innovation, but they have all slumped while Chinese tech stocks have powered ahead. So the big question for investors is whether this is all a short-term adjustment to tariffs or if it's a bigger, more long-term shift in the global order. What if the U.S. is no longer home to the best innovations and free trade? Or what if it's no longer seen as a friendly trading partner or a safe place for capital? If these foreign outflows continue, it will put pressure on U.S. stocks and potentially keep our interest rates higher. And do you know who is overweight U.S. stocks? U.S. investors. This is called home country bias. Put simply, investors tend to allocate too much of their portfolio to their own domestic stocks. As recently as 2022, investors had about 80% of their portfolio in domestic stocks, but the U.S.'s weight in a global index of stocks is only about 66%. So while that imbalance has been very rewarding for U.S. investors over the past 20 years, it's also led U.S. investors to dramatically overlook international stocks. So right now, the world order is changing. We're not going to have the same relationship we've had with foreign countries from now through at least the end of the Trump administration. And it's hard to even picture what direction our country will be in come 2028. But the international community already feels very differently about the U.S. than it did just a few years, if not months ago. In short, it's time to revisit your opinion of the American financial empire as well as the global composition of your portfolio. So, all this is why I wanted to bring in Dan Ferris. He's the editor of the Ferris Report and Extreme Value here at Stansberry Research, along with his brilliant Friday Digest, which you can get for free at stansberrydigest.com. Now, Dan is a bottom-up investor, and he likes to say, prepare, don't predict. But in his November issue on the risks and opportunities of a Trump presidency, he warned higher volatility and stock market declines lie ahead. And in late January, he warned that the markets were flashing red. They went on to peak on February 19th. So Dan has had a good read on this all along. So Dan, I'm just going to start with the big question. Tariffs are crashing the market. My first question is just, we're all watching these tariffs sort of tank the market. Where are we? Is this just the start of a longer bear market, or have we adjusted and we've made the move downward and we can invest, normally from here out, so to speak?
But Matt, Scott Bessent told me that it wasn't tariffs crashing the market, and he must know, right?
Yeah, he's gone from, if you read what he said a few years ago, he's not saying the same sort of things now. He's trying to be a team player there. I don't get the feeling he likes these things.
It's a funny thing about going to work for the government, isn't it? All of a sudden, the priorities shift. The incentives are completely different. Anyway, I'm sorry. What was the question?
The question is, look, we're down as of now, as of Thursday, we're down 4%. Tariffs are kind of a one-time announcement in a way. Right. But is this just the start of a longer bear market, or is this an adjustment, a re-rating of stocks? And you can, I don't want to say treat it as normal from here on out, but has the crash happened, or is it happening?
Gosh, I guess if I knew that sort of thing, Matt, I wouldn't be constantly saying, prepare, don't predict, because, I don't know that there's been a correction until after, right after it happens and the market is down 10% from some point. Then I say, oh, there's a correction, as we all do. So I don't know, but let's just say this. it certainly wouldn't be any surprise to me if this were the beginning of an actual bear market, and nor would it surprise me if it were eventually, a minus 60+% event, or like a minus, less than 40% event. It's there are reasons to suspect that both are possible. And I just think that right now, if you're trying to allocate capital by predicting how any of this is going to go, you're going to make a mistake. You need to take a step back and prepare for the worst, and prepare for the best too. It sounds like terrible advice, I know, but I think more than ever at this moment, and I've been saying this in the Ferris report for some time, I think having a really well diversified portfolio in which you have assets that just aren't going to behave the same way under the same circumstances, they aren't correlated, most people would say, is really important. It's super important.
And I was on your show a few weeks ago, and we were talking about how so many investors have this gambler's mentality now, and they're trying to trade these things, and they're trying to predict them, and they're making huge bets on, I think markets will go up after this tariff announcement. And that's kind of why we're doing this. We're trying to explain to people, you want some tariff positive businesses, you want some tariff negative businesses, and you want a small amount in each one. These sounds, diversification and correlation, they sound like platitudes, but the people who have gotten most interested in investing the last few years are absolutely not doing that. They're making concentrated bets thinking that they know what's going to happen today or tomorrow. And I will admit, right, if I had to have made a bet on what would have happened immediately after the tariff announcements, I would have been bullish. I would have thought, he's prepared everyone for the worst. He's going to pare it back a little bit. There'll be probably the 10% baseline. But man, that is not what happened. And if I had put an oversized bet in that, I would have lost years of investment returns.
Yes. You simply cannot. You can't really do that consistently over time anyway. Most people just they can't do it. They're not going to be, we get these stories of like Soros and Druck and all these people who, be a pig, take a position, all that crap. And it's just, the average person is never going to do it. So yeah, people are over concentrated, and they have too much of a gambler's mentality. You can see that in this record amount of assets pouring into, like, highly levered single stock ETFs and the like. So yeah, that is a symptom of people making a big mistake all at once. I think stocks trading near their, most expensive values in history by several measures is a good enough sign for me of that. And I think that you have to be careful. You can't base any part of your investment portfolio on your ability to make predictions. And if you do engage in that type of gambling, please make it some small amount of money that you can afford to lose 100% of without ruining your life or your retirement or anything.
Okay, Dan, what about this idea of the end of American exceptionalism? We've seen huge capital inflows starting to reverse, at least over a month or two. Is this a big shift, or is it just a little bit of noise in the data?
So it's a big shift, but I think it's a touch more complicated, one step or one level more complicated than most folks will understand right now. I continue to say that the paradigm in your mind is kind of price the US dollar in all the other currencies in the world, and then price gold in US dollars, right? So that would have gold appreciating versus US dollars as this massive reset plays out with, tariffs and whatever they're going to do to try to weaken the currency, the so-called Mar-a-Lago Accord effect. So there's that, but then there's also the fact that there's still a huge demand for dollars everywhere. I mean, people, they to prop up their own currencies, they sell treasuries to get dollars. that's that's why they have the treasuries. They sell treasuries to get dollars to buy, yen or pounds or whatever it is they're trying to do. Um, so they do wind up with, less in the end, but there's an initial, greater demand. Plus, I think Bank of International Settlements, last time I looked, had it at maybe between 12 and 13 trillion of US dollar debt outside the United States that requires, some financing. And there's a further slight complication that this effect is also present in the euro, so there's euro debt outside of Europe, mostly in Africa, and there's, um, yen debt, whatever, yen outside of Japan, euro outside of Europe. It's a similar effect. So it's a complicated situation. Yes, I think for Americans, the dollar gets weaker relative to all the stuff they buy and relative to gold, relative to expenses, to life. But I think other countries weaken, before. If people say, well, the dollar's done and it's going to crash, well, all those other ones are going to crash first. If that's true, the dollar is the last, the cleanest dirty shirt in the laundry, or the prettiest mare at the glue factory, or whatever. There's any analogy you like, and it becomes glue last. And under that scenario, gold winds up being a kind of last man standing at 10 or 20 or 30,000 bucks an ounce, or some crazy amount like that. And I think we get more gains in gold. I won't make a prediction of the price, obviously. You just want to own it. But unfortunately, I think, not appreciating this further complication of the relationship of the dollar to other currencies might mess people up a little bit.
Yeah, we talked about gold last week, and it's a great diversifier in this sort of situation.
Yep.
Okay, so
as are dollars, frankly.
There you go. Yeah, cash and right. If your market's crashing, you want some cash.
One little more macro point is, I think an important trend over the next several years will be kind of the end of the sort of the reign or the primacy of financial assets so much, relative to what it's been, and then the importance of so-called real assets in whatever modern way you want to think of it, data centers and nuclear power plants and whatever modern infrastructure is needed, in addition to the regular stuff, roads and bridges and all that, but and copper mines and all the things that feed into that modern infrastructure. I think, I forget who it was. I think it might have been Hugh Hendry or somebody recently who said, in 20 years, you won't be bragging that you owned Apple for 10 years and got, a multi-bagger out of it. You'll be bragging about the factory that you own a piece of, or the mine that you own a piece of, or what, the mining company, or the data center company or the data center that you own. Or, you see that the bragging is going to be different. So I think that's pretty important too.
Yeah, well, this turn to sort of businesses is what I wanted to ask you about. You are a value investor, and we've all been looking at foreign stocks. Europe, Japan, they've all been extraordinarily cheap compared to U.S. stocks, but it hasn't paid off for anyone. Japan started to catch up a bit, but they've just sat there, right? Mm-hmm. Do you see an opportunity in those in foreign businesses, Europe, Japan, that looks, I mean, they just look so cheap compared to the U.S. now? I imagine you're learning French to read some foreign annual reports or whatever you might be doing, all those books behind you. Right. Do you see opportunities in those?
Yeah, my French still stinks. It's still back where it was at the end of high school, and well, at college, I guess I took it too. But yeah, I think with Japan, it's a structural issue in the market for a long time. And the easiest, most obvious thing is the cross holdings, right? They all owned tons of each other's stock, and the culture was to just hold enormous sums of cash, and so if you look at the ROE over time, it's like the average is like 2% or some crazy low number like that, because the E was enormous because they were stuffed with cash. And they're figuring out that that's not really the greatest way to operate, and they're fixing it. And it's been underway. The fixing has been underway for many years. I think I wrote about this, in 23, when I recommended the Japan fund that we have in the Ferris report. And it was ongoing for many, many years before then, and it's continuing. And so that structural working out, I think, will be very good for Japanese equities. And I think, Europe has done really well, actually, since Trump was elected, counterintuitively, right? So it's, just because it got so cheap, and certainly the American exceptionalism in equities is very likely over. You can talk about the dollar, and that's a more complicated subject, in my opinion, but the U.S. stock market trading at 37 CAPE or something, versus Europe at like 12 or 15, but I don't mean all of Europe. I mean different countries here and there. I think the Europe funds that we were looking at were all around 17, 18 times where the current earnings, where the U.S. funds were high 20s. So yeah, I think there's excellent relative value in Europe, and I think the structural problem in Japan just continues to work out. They continue to disgorge cash, and they buy back shares. Ooh, that's and get rid of their cross holdings of each other's companies, right? Because if they have cross holdings, that was kind of a corporate political thing. They could keep investors at bay because they owned a lot of each other's company. They said, well, we'll scratch your back if you scratch ours. And they're realizing that's not a great way to do business.
Exactly, Dan. I think it's time for investors to reassess their international portfolios, look for opportunities. You can read more of Dan's analysis. All you have to do is sign up at stansberrydigest.com. He writes a digest every Friday with these sort of ideas in it. And of course, like and subscribe on YouTube to stay up to date. Dan, thank you for joining us. That's all for today, and I'll be back next week.